Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Insteel Industries, ticker IIIN, because they had earnings this morning and they missed on earnings, and we need to lower some of our expectations on the company for this year and next year. But we need to see if that poses a buying opportunity or if it has a large negative impact of the valuation. So these are all lines from the last time we looked at it, all of the technicals. We had a margin of safety around $47, a price that the stock has never even come close to. Uh, it hit a high in mid 2022 at 44.29, and right now it's sitting at 31.20 off of a drop on earnings. Today, it actually had a very large drop at open, dipping down to 28.41, and it's worked its way back up throughout the day. I had put a video out on it on the 13th of last month, so a little over a month ago, where I talked about how I saw potential in it, and I titled it "The Double Bagger That I'm Buying." So right after I posted that video, I sold a put, a $30 strike put on the stock, and collected $60 in premium. That expires tomorrow, so it looks like I will be keeping my $60 in premium, and I'm going to open another one, which at the moment looks like you can collect around $50 in premium. The reason that it was higher last time is because earnings, and people were expecting a drop off these earnings, which they did get, but it's recovered since because, as we'll get into, this drop doesn't affect the stock too terribly. So that's enough with the chart. We can get into the actual numbers and see what's going on there. So for the numbers, we have our last update here. Analysts were expecting this year's revenue to come in at 1.1 billion, earnings to come in at $2.48, and majority of these fields were calculated out. So we were looking at a fair value around 57.75 and a margin of safety around 49 and overvalued, let's say around 64. For next year, it would go to 1.45 billion, 338 in earnings, and we were ending up with a fair value of 75.85 with a margin of safety at 64.50 and a overvalued at 83.82. So I have updated everything in here. We have year to date. They're actually reporting their Q3 earnings. So there's 1 quarter left for them for the year. They have a slightly different financial schedule than one would assume. We're halfway through 2023, but they're in Q3 of 20. They're now in Q4 of 2023. We see the goal here. So I have adjusted the revenue and the earnings down because they're definitely not going to make those goals. They were coming in 30 to 40% of that, and they have 1 quarter left. So analysts have adjusted their revenue expectations down, but not their earnings per share. I actually adjusted down the earnings per share for both this year and next year. So our 1.1 came down to 0.72, and next year's 1.5 came out to, let's round it up to 8. Earnings per share, I dropped from $2.48 to $1.92. So far, they're at $1.37. So we'd be looking at a slightly better quarter in Q4, which the CEO seems to think is going to happen. Our revenue assumptions would be the same. They're coming in at 68% of this new estimate, and they'd need a pretty good quarter, Q4, to hit it. Now, it is a decline from last year. Last year was an exceptional year. They jumped from shy of 6 to 800, shy of 600 to 827. So a 718 would kind of be more in line with what we'd expect. We'd expect the 590 to go to like 650 to go to 700. But they just came in really hot this last year. So it's not awful. As it may look, the year-over-year declines, they had a really good quarter this quarter last year. We can look at some of the other things. Basic average shares, they are on the decline, which is what I like to see. They're buying back those shares. And common stock equity did decline a little bit. So we'd want to see that growing. They have been really good at growing it very fast. So slightly concerning. I do see in the balance sheet that their debt is way down. Their assets have gone down quite a bit as well. As for a dollar value, the assets have gone down more than the liabilities. It could be that they're holding less inventory. Their actual tangible assets have gone up. So they do have that trending in the proper direction, which is really the number that we truly care about, because that brings the book value per share to 1842, and their cash on hand, they've got a lot of cash, $4.71 per share. Their liabilities, 70.32, a lot of that is current. Over 50 of that 70 is current debt. So we'd expect that to either be refinanced and pushed out to the future, or they'll just pay it off. They have plenty of cash. They have $21 million more than they have in liabilities. So debt is definitely not a worry for them. They have a 0.19 debt to equity ratio, so they can definitely handle that. Nothing to worry about there. Free cash flows, they're actually very close. They're probably going to beat on free cash flows. I did not adjust this number from the last update, which is nice to see. They're continuing with that growth trend. This last year, it was negative. You'd have to go back and watch my last video, which I'll have a card for, to see why we had a negative free cash flow, and still it's considered a buy. So the assets did shrink. Tangible assets grew, though. So they kind of balance each other out there. ROE is going to come in very low, which I do not like to see. Their net income, their net percentage, net income, everything is just kind of bad this year. They're currently sitting at 5.5% operating margin, and off of our expectations, we'd be wanting something closer to 8. And even that is a little low, considering that last year they came in at 15, 2021 they came in at 11, although it does beat the 4 that they had in 2020. So it definitely looks like they saw some really good growth for 2 years, and they're trying to figure stuff out. They do have initiatives to help drive some of these numbers, which we'll get into when we take a look at the earnings. But the fair values. So this year, we're now coming up with 53.5. Previously, it was 57.75, so that did come down about $4. And the margin of safety came down as well. It was 49, now it's 45.5. The sell, of course, or the overvalued, of course, would have come down as well. Next year, we were looking at a fair value of 67.86, which has gone down to 55.04. And the margin of safety would then be just shy of 47, and the sell would be just shy of 61. Still significantly higher than the stock sits today at 31. So it's not quite half the fair value as it was previously, but it's still pretty close to it. Looks like about 42% undervalued. So I don't think that it's a bad opportunity to double down on the stock. I'll probably reflect that in the 3 portfolios. I'll add a second share at the current price of $31. Here's the CEO's outlook for the company. Given the lethargic market conditions we experienced during the third quarter, our financial performance was reasonable, reflecting the easing of headwinds that negatively impacted our results for the first half of financial 2023. So they are seeing some of the problems that they had clearing up, which is good. Shipments and spreads improved during the quarter as inventory levels moderated, although shipment volume was well below our expectations, commented the CEO. As we head into the fourth fiscal quarter, we expect a modest recovery to continue, driven by non-residential construction activity and the recovery in residential markets. The outlook for infrastructure construction remains favorable as federal spending for the Infrastructure Investment and Jobs Act is expected to begin to drive demand as we move into the second half of calendar year and beyond. Additionally, we continued to progress towards completing several ongoing capital projects focused on broadening our product offering, expanding our capacity, and reducing operating costs. Those three things there are what they really need to be working on at the company. So I really like to hear that. We expect the first two projects to be fully commissioned in the fourth quarter of the fiscal year, followed by the remaining project in the first quarter fiscal 2024. So they know what they need to work on. They're focused on it. That's what we need to hear. For this company, the balance sheet and the cash flows are good. Looks like the main driver for the value is that balance sheet, followed by the earnings, and then the cash flows, and then the dividend. The dividend, we're expecting another 3-cent dividend in Q4, and they seem to be very consistent with the special dividend that they pay out. So we don't have that in our projections for next year. Which really cuts down that dividend valuation because we can't rely on a special dividend, but it'll likely happen. So, of course, the value would be higher for next year. Even there, we're looking at a 4% growth. They've been holding their dividend at $2.12. If we update this to $2.12, that fair value comes up to 57. 57 means we'd be looking at something more like 7% growth on the stock, which is pretty good. We want 8 to 10. We're really hoping that they're able to get back towards those 2022 numbers. And that's what we're looking at for this stock. So I think that it's still a buy. I'm going to double down. I'm going to sell another put because my put expires tomorrow and it looks like I can fetch another $50 in premium. So if I am to get assigned, I'd be getting assigned sub $29, which would be a very good entry point for the stock from what I see. I mean, even off the technicals, sub 29, there's so much support there that I don't see the stock really breaking below that. And even if it were to, it'd only be going down to 27.5. There's another super strong support there. Based on what we're seeing, we're starting to see an uptrend really continue. And that is really what we like to see. You know, they hit a bottom back here and they've been climbing ever since. You know, it's going to take a while for them to get up to their fair value at the pace that they're going. But if they're able to continue and finish up those projects, I think that they can do it within the next year. We could see this stock up in the 40s, 50s. So thank you guys for watching. Please like if you enjoyed the video, comment if you disagree, if there's any other stocks or earnings we need to look at, and subscribe so you can stay up to date on everything. And I'll catch you next time.